So welcome to today's deep dive. Imagine, if you will, that you're reading a highly technical financial manual. You're just, scanning through this dense wall of algorithmic jargon.
Right, tracking all those strict mathematical setup.
Exactly. You're reviewing the parameters for, say, an EMA20 on a 15-minute time frame. And then right in the middle of a literal formula, the author just drops this line, breathe in, stillness is a weapon.
Which is, it completely disrupts what you'd expect from a sterile trading environment.
It is such a jarring pivot. Today's source material is exactly that. It's this bizarre, brilliant collision between a Bloomberg terminal and, like, a Zen retreat.
Yeah, it really reads like that.
We're looking at this highly curated, deeply personal cheat sheet of trading notes, and while it's ostensibly this mechanical system for navigating price charts, if you look closer, the actual mission of this document is entirely psychological.
Oh, absolutely. It's really a masterclass in why emotional control and, well, patience are the ultimate non-negotiable prerequisites for tracking any market trend.
Right, and I want to get into that because the contrast is just wild to me.
Well, the underlying premise of this document is that in high-stakes, fast-moving environments, human beings are fundamentally flawed.
Yeah, we really are.
We like to think of ourselves as these, rational actors executing a strategy. But this author recognizes that we are emotional creatures. We're highly susceptible to panic, to greed, and especially to that biological urge to predict things.
Which is where all those rigid technical rules come in, right?
Yeah.
The hyper-specific moving averages and time frames.
Exactly. They don't exist merely to map the market. Their primary function is literally to protect the trader from their own mind.
That completely reframes the entire concept of technical analysis for me. Like, you aren't putting indicators on a chart to see the market better. You're doing it to stop yourself from seeing things that aren't actually there.
That's a great way to put it.
There's this specific quote from the notes that captures this perfectly, I think. The author writes, "The trend never hides. It is only the mind that flips back and forth."
I love that quote. That is the core pathology of a trader distilled into one single sentence.
It really hits hard.
Because the human brain is a relentless predictive engine. Evolutionarily, we are hardwired for pattern recognition because, anticipating the future is what kept us alive.
Right, it's literally survival.
Exactly. But in the context of the market, that biological imperative just goes completely haywire. We desperately want to be that visionary who spots the hidden reversal before the rest of the herd does.
You want to be the genius in the room.
Right. So when a price is in a steep decline, the data, like the actual observable trend, is undeniably pointing down. But the human mind looks at a plunging chart and inevitably thinks, well, it can't possibly go lower. I'm going to step in right now and catch the absolute bottom.
It's like trying to catch a falling knife in the dark based on a gut feeling. We just want to outsmart the system to feed our egos.
We really do.
And the author counters that evolutionary urge with this fiercely rigid rule, right? They say, don't assume it has gone down or up too much. Always stick to EMA20 at TF15.
Yeah, the 20-period exponential moving average on the 15-minute time frame.
Right, and they actually turn that indicator into a literal mantra. They write, what does the EMA20 say?
I think that's so clever. By forcing the trader to default back to that moving average, they are stripping away the narrative.
And the 15-minute time frame is fascinating to me here because it sits right in the middle. It filters out the hyper-reactive, chaotic noise of, like, a 1-minute chart.
Oh, the 1-minute chart is just pure stress.
Exactly. But it keeps you engaged enough that you don't just drift off into macro-level daydreaming on a daily chart. It serves as this perfect psychological anchor.
Yes, the metric is the anchor, and the mind is the storm. The author is explicitly demanding that the trader keep their mind as still as the EMA20 when it's a straight line.
Which sounds incredibly difficult.
It requires suppressing every biological urge to predict. When you feel that internal storm brewing, when your mind starts running simulations of what-ifs and, oh, it's due for a bounce, you are instructed to just look at the slope of that line.
You literally force yourself back to the objective reality sitting right there in plain sight.
Exactly.
But, recognizing that your mind is a storm is really only half the battle. If the brain is an engine that constantly wants to jump into the action and play the hero, just looking at a line on a chart isn't enough to physically stop you from clicking the mouse.
No, it's definitely not.
The document recognizes this, which is why it pivots from mental awareness to the actual physical mastery of waiting. The text is just absolutely obsessed with time and inaction.
It really is.
The author writes, "The stiller you are, the more you get. Wait calmly for the clock to tick."
Which is Deeply counterintuitive in our current culture. I mean, everything about modern trading infrastructure, and honestly, just modern work culture in general, equates hustle with success.
Yeah, if you're not moving, you're losing.
Right. And the interfaces themselves are designed with, flashing colors, instant execution, push notifications. They're all engineered to trigger these dopamine loops.
So the platforms are actively hostile to stillness. They are engineered to make you feel like sitting on your hands is a failure.
Precisely.
There is this palpable, almost physical friction to doing nothing when the market is open. The FOMO isn't just a mental concept, you feel it in your chest.
Oh, your heart rate actually goes up.
Yeah. So when the author implements rules like not trading on some days is a good strategy, or after exiting, take a break, wait to see a clear direction, they are demanding a behavior that feels highly unnatural.
Very unmatched.
Like if algorithmic high-frequency trading programs are executing thousands of trades a second, how does a human trader convince themselves that waiting for a 15-minute clock to tick is actually a competitive advantage?
Because the human advantage isn't speed, it's synthesis.
Yeah.
The algorithms, they thrive on the microfluctuations.
Yeah,
Right?
right.
The noise.
Right.
If you try to compete in that arena, you are essentially gambling against a supercomputer. In the context of what the source calls mindful trading, the absence of action is not a passive state.
Interesting. What is it then?
It is the highly active state of capital preservation. When the author says to wait for the clock to tick, they are basically telling you to let the algorithms fight it out until the noise subsides and the true, clear direction emerges.
It's like being a wildlife photographer, right? You sit in a blind for 3 days for that one perfect shot, rather than just running through the jungle snapping blurry photos of every rustling leaf.
That is a perfect analogy.
So doing nothing is an active defensive posture. You aren't missing out on a trade. You are executing a defense protocol to protect your capital from a chaotic environment.
Precisely. Forcing a trade when the environment is unclear strips you of your edge. True patience is internalizing the reality that preserving your capital is the ultimate prerequisite for growing it.
Because if you lose it all, you're out of the game.
Exactly.
Yeah.
If you spend all your mental energy and your account balance thrashing around in this sideways chop, you won't have the resources to act when the trend finally does reveal itself.
That brings us to the mechanics of what happens when the trend actually does reveal itself. Because the trader is waiting defensively, sitting perfectly still. But eventually, they do have to interact with the market.
Right, you have to place a trade eventually.
And the author bridges this gap between emotional stillness and mechanical execution with this really beautiful piece of imagery. They say, wait like bamboo, don't resist, don't rush, flexible and steady.
It's a powerful metaphor because it addresses the inherent danger of strict algorithmic-style rules when they're applied by a human.
How so?
Well, if your rules are too rigid-like, if you act like an oak tree, a sudden violent shift in the market will just snap you in half.
Ah, okay. And the author connects this bamboo flexibility to their specific rules of engagement. They advocate for moving slowly, saying slower is safer, don't rush in.
Which again goes against every instinct we have.
Totally. They specifically note that entering late in the market is fine, provided the trend is undeniably clear. But here's where I saw a fascinating tension in the document.
Oh, what's that?
The author insists at one point that price is more important than indicators. Yet, this entire framework we've been discussing relies on absolute obedience to the EMA20 indicator.
Right. It seems contradictory.
Yeah. How does a trader successfully navigate that hierarchy? Like, when do you follow the strict mathematical indicator and when do you defer to the raw price action?
That tension is exactly where the bamboo philosophy gets applied mechanically. The way to resolve that apparent contradiction is to understand the difference between the map and the terrain.
Okay, map and terrain.
Yeah. The indicators of the slope, the moving average, the larger time frame trends, those are your map. They provide the steady overarching context, but the immediate real-time price action. That is the physical terrain you are walking on.
So the map tells you that you are generally heading up a mountain. That's the EMA20 giving you permission to look for long positions.
Yes. But if a giant boulder suddenly rolls across the path directly in front of you, you don't just keep walking into the boulder because your map says the road is clear.
Right, you'd get crushed.
Exactly. You react to the terrain. That is the flexibility of the bamboo. If the immediate price action violently spikes against your indicator, price wins. Price is the ultimate objective reality occurring right this second, whereas an indicator is always, by definition, a lagging historical calculation.
That clarifies the mechanics of bending so well. Bending isn't abandoning your strategy, it's accepting the immediate reality of the price.
Yes, exactly.
You take a quick step back, maybe you take a small stop loss just to avoid the boulder. You flex with the sudden wind, but you remain rooted in the ground, and the ground is your larger time frame strategy.
That's right. And once the wind passes, you pop back up and consult the map again.
Which perfectly explains their rule regarding sideways markets.
Hmm.
The text explicitly reminds the trader that a sideways chop will eventually follow the trend of the larger time frame.
Exactly. You don't try to trade against the current while you wait for the wind to die down. You hold both concepts simultaneously. The steadfastness of the overarching strategy and the flexibility to accept what the market is doing right now without resisting it.
But, even if you master that balance, even if you are the ultimate mindful, bamboo-like trader, the market will inevitably present a scenario where your read of the map is just dead wrong.
Oh, it's guaranteed to happen.
Right. The trend moves definitively against your position. And this is where the philosophy faces its ultimate stress test. What happens to that mindfulness when the trader starts bleeding capital?
That's the hardest part.
The document addresses risk management with a ruthlessness that completely contrasts with that earlier Zen-like tone. The rule is ironclad. They write, if you are on the wrong side, move quickly, don't wait to break even.
Because the author knows that the moment a trade goes underwater, the trader's mindset instantly shifts from analytical to emotional.
It's just instant panic.
The psychology of loss is profound. Humans process the pain of losing capital with far more intensity than the joy of acquiring it. But in a field entirely predicated on analysis, the loss isn't just financial.
What else is it?
Well, when you execute a trade, you are making a public prediction. You are stating, based on your interpretation of the data, that you understand what is going to happen next.
Oh, wow. So you are tying your intellectual ego to the outcome of the trade.
Exactly. So when the market invalidates your position, it feels like a direct attack on your intelligence. The human ego absolutely despises being wrong.
Nobody likes to admit they made a mistake.
Right. And to avoid internalizing that failure, the mind immediately begins to negotiate. The mind, as the text warned us earlier, starts flipping back and forth.
The trader starts looking for any reason to ignore the terrain.
Yes. They look at a plunging chart and tell themselves, well, if I just hold on a little longer, the volatility will subside. It just needs to bounce back to my entry price.
Just to get back to zero.
Exactly. If I could just exit without a loss, my ego remains intact, and I can pretend the mistake never even happened.
It's essentially an attempt at time travel, right? You want the market to validate that your original analysis wasn't actually flawed. Waiting to break even isn't a strategy. It's a plea to the universe to save you from having to admit you were wrong.
It is literally trading your own hope. And the market is in a completely indifferent mirror. It does not care about your entry price. It doesn't care about your ego or your hope.
It's just numbers.
Right. The directive to move quickly and don't wait to break even is the ultimate execution of emotional control. Cutting a loss swiftly requires a trader to successfully sever their self-worth from their net worth.
That is so hard to do in practice.
It is incredibly difficult. You have to look at the objective data, acknowledge that the premise of the trade is broken, and manually take the financial hit to protect the remainder of your capital.
Which ties directly into their rule for success, right? Always take profit at TF2. They demand the trader secure gains on a rapid 2-minute time frame.
Cementing that philosophy that you manage your capital safely before you even think about profit.
Set a goal and follow the plan, not emotions. You take the ego completely out of the exit strategy, whether it's a win or a loss.
The moment you hesitate to cut a loss because you want to break even, you are no longer trading the trend. You are trading your emotional need for validation.
Wow.
And as this document makes abundantly clear, the market will aggressively punish anyone who prioritizes their ego over the data.
So, bringing this all together for you listening, we started by looking at a document that appeared to be this dense, mechanical cheat sheet of moving averages and time frames.
Yeah, just a bunch of math.
Right. But by decoding the underlying psychology of these rules, it becomes so evident that mastering a market trend is fundamentally about mastering oneself.
That's so true.
Whether you are actively managing a portfolio, or maybe navigating a complex project at work, or just trying to process the daily chaos of life, the same biological flaws apply.
Oh, absolutely. The philosophy embedded in these notes is highly transferable to everyday life.
Because our brains desperately want to predict outcomes, our egos refuse to admit when we are wrong, and our culture conditions us to view patience as a failure.
Right. When you find yourself in a chaotic, high-pressure environment, The principles remain exactly the same. You have to identify your anchor, your objective metric, and use it to shut down that anxious, flipping mind.
You have to recognize that sitting in the discomfort of inaction is often the most strategic defense you actually have.
And most importantly, you have to be willing to quickly cut your ties to a failing path without letting it bruise your ego.
You really have to act like bamboo, bend to the immediate reality, but stay rooted in your long-term strategy.
Beautifully said.
So to wrap up today's deep dive, I want to leave you with one final thought based on that opening premise. The document states unequivocally that the trend never hides.
Right.
But look at the modern information ecosystem we all live in today. We are bombarded with relentless streams of financial news, social media sentiment, push notifications, and just these increasingly complex data dashboards.
It's overwhelming.
It is, and we're told that consuming all of this data is necessary to stay informed. But if the trend truly never hides, are all of these inputs actually helping us see the reality of the situation more clearly?
That's a great question.
Or are they just sophisticated noise, perfectly engineered by algorithms to trigger our egos, make our minds flip back and forth, and ultimately rob us of our greatest possible advantage? Our stillness.
Definitely something to think about.
It is definitely something to ponder the next time you feel that overwhelming, frantic urge to react instantly to the noise. Thanks for joining us for this deep dive.